Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Niall Aitken, Head of Investment Strategy at Aegon UK, to the show. Welcome, Niall.
Thanks, Charlotte. Delighted to be here and looking forward to our discussion this afternoon.
Lovely to have you on the show. Do tell us, what is your news story of the week?
Well, Charlotte, I think there's a bit of a cracker here for you today that should provoke some interesting discussion. And I was interested to see an article that appeared in Professional Pensions last week. It was one by Jonathan Stapleton, and it was focusing on BlackRock's approach to designing portfolios differently at the moment.
And what was it about that news story that stood out to you and made it your news story of the week?
It just resonated with me. Obviously, for those that know Aegon UK, BlackRock are a strategic partner of ours. So, as they talk about their portfolio construction, it resonated a lot with some of the work that we've been doing within our team here at Aegon in UK. And really, as we bring a customer focus to the outcomes that we're trying to deliver from our portfolios, especially around some of the areas where the article talks about resilience and its applicability to defined contribution pensions.
So let's get into that. So how are you thinking of adapting your portfolio? How are you changing it? And given that with everything that's going on in the Middle East at the moment, I guess that might add sort of even more impetus to maybe help protect and add more resilience to portfolios.
Yeah, absolutely. And I think we'd come at that from two different approaches. I think we can maybe talk about some of the work we've been doing with our growth stage investments with our default solutions first. And then I think we can maybe get on to how we're extending that thinking into the to and through retirement space with some of the innovations that we're going to be have coming up later this year. But stepping back, growth stage investment, I think it's really, generally portfolios start from near 100% growth assets these days. So your barometer for risk is, how can you add resilience to portfolios without necessarily detracting from returns in that growth stage? So where we've been designing to include private asset investments within our growth stage default strategies, generally that has been that you're trying to add both resilience and a little bit of an additional return in the right areas. But, so generally adding diversification and resilience is been what we've been focusing on in the short term.
Yeah, so if you think about that, I mean, traditionally, maybe we could have been 100% passive equities. You talked about adding private markets in there. I would imagine at the moment, with that overexposure to US tech stocks, that might be an area that you wanted to try and add some resilience in case there's a big market correction around that. Can you talk about how you're approaching that and maybe also the private markets bit as well?
Yeah, absolutely, Charlotte. I think so. A couple of questions in there. So how are we thinking about accounting for some potential concentration risks? And this is where I would say global equities and a broad basket of global equities within growth stages have delivered extremely well for customers over the last 10 to 12 years, I think, in terms of having the exposure to booming global equity markets. But it is a very appropriate time to think about, with more assets not being listed like they were before, with the nature of global capital markets changing, is how do we make sure that the next 10 to 15 years are like that for our customers? And it is the right time with some of those valuation risks to think about diversification more, but equally with the lens of, if we want to maintain equal or better expected returns to how default strategies are currently invested, how do we do that without necessarily detracting from return, but by adding resilience? Like you say, we think the private markets are a good space. So when we went into designing the private asset strategies that we've developed over the last 2 years, it was really with a focus on what is the right strategic partner, what are the right assets to really think about a growth and resilience engines for those strategies.
And that right strategic partner of those private markets, are you managing all that in-house, or are you working with third-party managers too?
Mainly, so this is a very interesting topic in the market at the moment. Whether you in-house all that capability or whether you use strategic partners, I think, and we've gone down the strategic partnership line, which is we're looking. So we. In redesigning one of our largest defaults in the last couple of years, we went out with a whole of market RFP for the solution, really trying to find the best option for our members in the longer term. And we identified that we'd want to build some bespoke strategies. We've now got 3 live LTAFs in the market, one working with BlackRock, one working with JPM, and one with Aegon Asset Management. Throughout that RFP exercise, we really identified that no one manager is great at everything, no matter if they might tell you that.
Mm-hmm.
And actually, how private markets, how the case for them throughout the glide path and de-risking journey of our members is maybe having the capability to alter that exposure at different points in the glide path. So we wanted to make sure that we set up from the word go our private market capability to make sure that we can alter and change that asset allocation to different private assets, because it's a broad church, and making sure that we could hold a different proportion in a more diversified approach in some private credit to and through retirement relative to a more growth-seeking allocation while our members are younger.
So as a rule of thumb, would you be more interested in private markets that are equity focused earlier on in the member journey and then moving through to debt private markets, or is it more about the asset class? Is it about infrastructure versus property? So is it the kind of the where you are on the seniority of the capital structure of the individual company, or is it about the asset class, or a mixture of both?
I think it's a mixture of both. I think from our perspective, we're looking at the overall outcomes delivered for our customers and making sure that, if we are selling a basket of global equities and maybe a little bit of broadly allocated fixed income to buy private markets, we're then adding return without necessarily adding risk, and also then protecting potentially in some downside scenarios. So we would come at it from a more portfolio construction method and really getting into the potentially the nitty-gritty of underlying deal selection. We wanted to make sure we partnered with the right managers that saw a lot of deal flow. So especially as we've built out these solutions, to make sure that we have deals chasing, or exposure to deals chasing capital rather than capital chasing deals. And we've in selecting those key strategic partners, we wanted to make sure that our customers could get access to the absolute best of thinking across the board and a significant amount of deal flow, and that's what we think we've achieved.
So would you change the kind of would you be equity focused at the beginning and more debt focused into the retirement space? Is that a fair assumption? Or
yeah, no, absolutely. So I mentioned our 3 LTAF. One of them, the JPM LTAF, is a little bit more growth seeking. So that's going to have a little bit more private equity, but then also lean into some of the capability that they have that is unique to them and their global capabilities in transport and forestry, as well as the private equity aspect that we're designing with them. The LTAF that we built with BlackRock is more diversified. It's more of a solution that can be plugged in at any point in the glide path and is going to do really well for customers. It's a broad basket of infrastructure, real estate, private credit, and a little bit of private equity as well. And then we've got a specific private credit LTAF with Aegon Asset Management, and that is again designed to be so that can be held more to and through retirement as you introduce allocations as people start to de-risk.
I think it's interesting as well you decided to go to the LTAF route, because some of the larger master trusts would not decide to do that, and there are advantages to LTAF, there's quite a lot of criticism around them. You didn't decide to go for a bespoke mandate with each of those managers. What drove that decision?
Well, I suppose we have gone with a bespoke mandate in that we've built bespoke LTAFs. So, and that was one of the key thinking, I think, when I mentioned the RFP process that we went through. And I think it did identify that the pooled off-the-shelf solutions there were too many drawbacks from a large scale asset owner in terms of allocating to pooled LTAF solutions, because actually, they do need to contain quite a little bit of liquidity to get regulator approval. And actually, that's not so much of a hurdle if you can match that liquidity requirement to the liquidity that's in the rest of your growth stage, for instance, right? If you hold the same basket of global equities, for instance, within the LTAF to provide liquidity as you do in the growth stage, then you don't get that look-through drag that you might be holding too much cash or too much near cash investments within that LTAF. So that was a good point about having the scale to build bespoke solutions. Maybe takes away some of the challenges with LTAF, because the LTAF vehicle does help with how a lot of the rules and the regulatory requirements around DC defaults from both the TPR and from the FCA in terms of incorporating them into defaults and making sure that they're priced and then can be easily held within the top level solution.
And also, sort of talk to me, you mentioned downside protection there as well. Okay. Kind of what kind of things are you doing? Because you obviously, downside protection is, well, anything that's insurance, including insurance itself, right, is never cheap. So you don't, as you talked about, making sure that you don't have a drag on returns. So yeah, what are you doing around that?
I think I can maybe speak to some of the work that we're doing in our to and through retirement allocations, and this gets back to the article as well, where we're thinking about if we have customers who are accessing their retirement savings and starting to draw down on that for the first time, resilience tends to mean what are the shape of returns? How can you provide protection to avoid almost cohort-specific outcomes for those customers, that they have a really bad couple of years at the start of their drawdown journey, at the point at which they've accessed tax-free cash, or the point at which they maybe do spend a little bit more in retirement at the start than they might do in the longer term. So those sort of outcomes for those customers, that's an awful lot of risk, and that tends to be cohort-specific, because that then means they're facing into a lot of market risk at that time. So this is then where you're thinking about flexing the levers that you have from a portfolio construction perspective to say, what is it that we can use to potentially change the shape of some of these outcomes. And these scenarios that we're particularly worried about there are generally the ones where your correlations and your long-term expectations are maybe different in the shorter term than you might see. Using an example, we might be thinking about 2022, and the time around the mini budget where you saw fixed interest and global equities be quite correlated, and both head quite negative in that shorter term. And actually, traditional diversification in that ways that said, a 60-40 portfolio is quite resilient. In that sort of scenario, it doesn't perform well. So you're thinking about testing your portfolios in scenarios like that. But that's not just backward looking, it's from that forward looking assessment. That's what the article covers quite well, and some of the work that BlackRock are doing, and how we're working with them on that, how that's impacted our thinking. We're thinking about, maybe a little bit less traditional fixed income in an endpoint, and we're designing a protected equities strategy to be held in our at retirement portfolio, which we're particularly thinking of that scenario that I mentioned in 2002, and what different levers could you have to change the shape of outcomes for customers.
So in that protected equities, does that mean that you're using something like options to minimize downside? To link back to what you're saying about cohort risk, like, for example, around as you say, 2022, or even like the global financial crisis, if you happen to be like at your peak pot value or just about to retire at that point, when you get this severe market correction, that can obviously severely decrease your wealth. So you can't know which cohort is going to go through when. So is it about sort of just applying that blanket protection, that blanket downside equity protection across the whole portfolio and every single cohort? You know what I mean?
Yeah, we would be treating, in that case, protected equities like an asset class with its own risk and return characteristics. And how does that play through into the overall outcomes across maybe a 30 or 40 year in retirement decumulation journey. So that's, it still has to earn its place in the portfolio from a capital allocation perspective. You're not just giving up potential returns to then plug in a little bit of short-term protection. You're looking at how can you use the financial options and derivatives that exist in the market to then provide or give away a little bit, or not give away, sorry, sell a little bit of the upside that members at that point in their journey don't require to provide an awful lot of protection on the downside. And it's not necessarily trying to time markets or trying to be extremely clever with, the VIX is spiking or volatility in the market is changing and we're trying to time it, whatever it is. It's just fixed rolling option strategies, like you say, that can sell expected upside to provide protection on the downside.
Okay. Well, I mean, protection is always cheaper when it looks like it's less likely to happen as well, right?
Oh, absolutely, right. So you have to then make sure you test the design of that strategy extremely well. Make sure you have robust options rolling strategies, and making sure you account for that in the design. You can't have 100% of your underlying protection rolling on the same day, because you are exposed to the price of those options changing and protection getting more expensive when you most need it.
And I mean, we talked about, you mentioned private markets, presumably as part of that as well. You mentioned giving up some of your private credit allocation to have this protect equity, which I think makes sense because it's a more genuine reflection of the fact that people are going to need to be invested for longer in retirement. Retirement could be, depending on your particular longevity risk, retirement could be 30 years or it could be 5, but you need that ability to keep making money to give you the best ability to not run out of cash before you die, especially if your longevity from 65 happens to be out until 95, for example.
Yeah, absolutely, Charlotte. This is sort of the package of things that we're doing. We talk about how do we design the right investments for our members second 50. So this goes back to, Aegon have done a lot in the market over the last couple of years on thought leadership around preparing for your second 50. So when you hit 50, the concept of the 100-year life, and that's where the second 50 comes from. So more broadly, we think you need to take a little bit more risk at retirement, so to support those longer term outcomes. But in that context, we are thinking about how do you do so without necessarily increasing that risk of it going against you in the shorter term to and through retirement.
And what about that longevity risk? I mean, because you've seen Nest come out and do a deferred annuity with, is it PIC or Rothschild? I can't remember now, but putting a deferred annuity in place. Is that something you're thinking about too? Because, I mean, that seems to be sort of conventional wisdom that people are going to want to spend their money in the first, say, 10 to 15 years of their retirement. Then as they slow down, become more tired, maybe older and sicker, they're going to want to spend less. And then at that stage, it's about protecting their income so that it lasts the full length of their lifetime. Is that how you tend to think about it as well?
I would say yes and no. I think we've probably learned from the experience of our customers that if you ask them to buy an annuity at a certain point, then even if it is the right thing for them, and if you ask them to describe what they might want, it might sound exactly like an annuity, but when it comes to the crunch, they might not buy them. Right? Actually, I love annuities. They're great products, but we can't get away from the fact that the experience over the last 10 years has been that our customers aren't buying annuities, and if you show them that option or default to that option, a lot of them will not take that choice when it comes to the retirement outcomes, even if the smart people in the room might think it's the best for them. So how we are thinking about the to and through retirement solution is very much that: what support can we provide to our customers and sustainably drawing down on the retirement savings, and are there guide rails that Aegon can provide to somebody on the way in to that drawdown? So how do you help them with that? How much should I take conversation? And then how do you help them stay on track versus their retirement goals? And that's one bit of that is our end of things in terms of the investment, but it's also product, and it's also tooling and support. So often describe that sort of three-legged stool, and it's all got to be working in really good harmony. I think annuities do play a part in that. I think we should be signposting to our customers when annuities present good value, and making it really, really easy for our customers to move into annuitisation if it's right for them relative to the goals that they're seeking. But I don't think we'll be defaulting to that. But equally, I'm straying into areas outside of the investment space, Charlotte, so I don't need to get one of our proposition team on to talk about that. But I'm sure they would love to. But yeah, it's a fast evolving space, and there's going to be more consultations later in the year about the default retirement benefit. I always get that one wrong, but I think that might be right.
Okay, so if we move back to safer ground, if we think, when you think about that kind of like that sort of wealth building, then that wealth spending phase, what are you thinking about in terms of what kind of performance? Do you have a number in mind in terms of the annualized returns that you think you should be generating at each of those phases? How are you thinking about performance?
I think that's a very interesting question in the context of the VFM consultation that's out there at the moment.
I was trying to steer you in that direction, yes.
And I might pivot that way. And and I know I suppose I've benefited from the timing of this podcast, that there might be a lot of investment professionals on a train towards Edinburgh that might be discussing some of this next week. So, when it comes to performance of an at retirement default solution, this is where the VFM consultation would say it's all about wealth accumulation. And I think this has been widely discussed in other places, but I do agree with, in terms of if you're making portfolio construction decisions, that maybe think about adding resilience other than just maximizing central return expectations. If you're more concerned for your customers at that point in their journey about potentially, I've mentioned this a lot, changing the shape of that outcome of distribution, it might be that you give away a little bit in the middle to provide that protection from the sort of tail events that would most see them not meet their retirement goals. Now, would you then say that if you were to do that, and that produces a capital return that is slightly less than a solution that didn't do something like that, maintained a standard 60-40 or 70-30 portfolio, sort of the norm at the moment. So that type of thing, where actually no market events were happening, it's quite quiet over a 3 or 5 year period, and that solution outperforms. The regulations might say something like, oh, well, actually, you've not provided value in that, and propose potentially shutting you down to new business. And that's the extent that if you do something different to and through retirement than just wealth maximization for a given level of risk, it's hard to see how that fits alongside the proposed regulations. And I come at this from a lens of somebody that's looking at continued drawdown. I can only imagine how that might look if you're looking at CDC as your option, or any sort of partial annuitization approach where you're looking to match some of that exposure with long bonds.
And so VFM at the moment, there was a debate about it, and some of the concerns is there's not enough focus anymore on the services. How are we going to kind of adapt VFM for the retirement part of the market? I know that we haven't even built it yet. So is that also a concern, how you measure retirement? Because if you're talking about, you mentioned, you may be giving up some of the upside in order to protect cohorts from experiencing downside. So does that become, I think maybe you've sort of answered this question, but does that become even more of an issue when we get to the wealth spending stage? And what exactly is value for money at that wealth spending stage becomes even harder than the wealth accumulation phase?
Yeah, absolutely. And I think it's going to be unclear how the VFM regulations apply into retirement. So at the moment, it sort of stops at retirement, but with a assessment of the capital wealth accumulation aspects of how your at retirement portfolio has done. There isn't much extension of that into retirement at the moment. So I think that probably needs to change potentially in terms of how the regulators are thinking about that. But ultimately there are a lot of challenges around the proposed VFM metrics, and it's essentially becoming a performance test based on capital accumulation methodology, and that has some herding risks and things like that.
So if I give you a magic wand and you could change anything about the VFM framework, what would you change?
I'd do a lot of things. That would be a powerful magic wand to have, Charlotte. I would like that, But ultimately, from a methodology, quantitative perspective, I would like it to align with what members actually experience. So you're basing the assessment of value on what customers have experienced. That gets into the whole arithmetic, geometric, proposed calculation methodology debate. I don't really want to get into that, but it's not really aligned with what our customers experience. Secondly,
I find it's a bit mad if you think to kind of like have something that's designed to be compounding to then not measure it on a compounding metric is a bit weird, isn't it?
Well, you allow for compounding over 1 year and de-risking over 1 year, and then average over 10 arithmetically. So it's a bit muddled, perhaps. I can understand why they might do it to try and create something that allows for comparison. But, that is potentially only for comparisons purposes as a useful number and has little relevance to anything else. So that would be the first point. Second point I would maybe go with would be around, I'm not a big fan of forward-looking metrics. Well, I am a big fan of forward-looking metrics in the design and construction space, but not when it comes to the assessment of value. And this is where I think there has to be more scope for some of those qualitative aspects, like you mentioned, engagement, design, but also qualitative aspects for trustees and decision makers, with whether that's trust-based or in the GPP world, to say, actually, okay, backwards-looking performance might say this is amber or this is red potentially, and allow you scope to potentially move it up one based on improving expectations of the future as a result of we have delivered this. And yes, we can see where that sits, but we have made these changes, and therefore, as a result, we expect it to be better in the future. I don't think you should quantify that second piece into the first part of that process about the definition of value. It's more the value is something that you've delivered.
I mean, could we get past all of this by just talking about net returns and comparing them?
Well, yeah. And I think that there has to be then scope for those to be different as well. And there's maybe a little bit of uncertainty in terms of different risk levels of defaults and things like that, whereby how the regulator will compare and produce your comparators for assessment against that. Will it be accounting for risk-adjusted returns? Otherwise, any default strategy that's not been sort of 100% global equities for the last 10 years is going to struggle. And I think there are some unintended consequences there too. If that happens, then, we know the government agenda is for more exposure to UK productive finance and potentially further down the line, more UK listed exposure as well. And ultimately, if those sectors are to underperform the global basket over the next 5 or 10 years, it could potentially accelerate movements away from the UK because of the regulatory framework, rather than allowing you scope to be different for what might be very good reasons.
And so you mentioned herding, and I think that's kind of something that we end up with everybody being all around the same area, and it basically reduces the industry to tracking the same benchmark, which means building the same portfolio, which means you kill any innovation. And things just get, as an ex-investment analyst, very boring very quickly, and it doesn't really offer a lot of choice to people either.
I'm inclined to agree. Charlotte, I think herding probably happens at the moment to a certain extent. If you think about how the workplace market works and the role that BBCs play in that, but I think that generally means that herding should happen towards better quality things, right? This is the employee benefits consultants will rate all providers' default options and will give higher ratings to the things that they think produce better customer outcomes. And you can challenge that, you can lead that view, but ultimately there's a customer centricity to that allows for innovation, because they're constantly looking at the investable market, what options are driving the best potential future outcomes for customers. So, that herding by those gatekeepers, I would argue, is a good thing for customers, generally in the long run. But if herding happens without that same sort of direction, it might just be to what is performing the best in the short term. And that then creates significant risk. It could speed up herding towards productive assets and broader diversification and potentially more UK exposure, but that would be dependent on outperformance emerging over the short term, or one default having significant exposure to that and shooting to the top of the charts, and then you being held accountable for your decisions relative to that other default's performance. So ultimately, I think herding happens. It's how you control what people herd to, and the speed at which it happens, and the scope to be different from the herd. And I think that maybe exists at the moment, but you can see a future where there's less potential scope for that happening.
Okay. Well, I think that's a fantastic place to leave our discussion. We've certainly managed to cover an awful lot of ground in half an hour. Thank you, Niall, so much for all of your insights and expertise. It's been a great episode of the podcast.
Oh, thank you, Janet. You're too kind. I have enjoyed the discussion. Thank you.
And listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, do hit the subscribe button and do interact with us. Please do comment, take part in the Spotify poll if that's how you consume your podcast. And thank you for listening.